Hey guys, Eric here, Mr. Fired Up Wealth. And today I'm going to bring you a video on Microsoft and the power of dividend growth investing. Now, you might have seen this video, and if you haven't, you should check it out. It's how to build a growth portfolio. And if you've seen this video, if you haven't seen the video, I'm going to put a link above, a card. Go check that video out. I think it'll be helpful, especially if you're a younger investor or a newer investor and you're trying to figure out how to build a quality portfolio. Now, I'm going to go through this really fast and show you. So on this video, we do 25% ETF, 20% DGIF. The rest is growth and cash and different things. And you can watch that video in your own time. This is what I want to focus on right here, this DGIF. So 20% of a growth portfolio for a young investor, somebody that's trying to maybe retire, younger than the average age. They typically, for me anyway, if I were to build a growth portfolio and I was a younger person, a younger investor, I'd want about 20%. And you could do more and you could do less. You can adjust it how you want. But 20% in DGIF. Now, DGIF is dividend growth investing for FIRED. FIRED means financial independence, retire early on dividends. So the whole idea behind FIRED and the Fired Up is financial independence, retire early, and to live off dividends. So have enough capital where you have dividends coming in and you could live off those dividends and not sell the stock. So that's what Fired Up is. It has dual meanings. It's a cool name. You get it. So DGIF is dividend growth investing for FIRED. And on this, I recommend that you have between 10 and 25 individual stocks. That depends on, the size of the account. So if you've got a smaller account, maybe it's 5 stocks, maybe it's 10 stocks, whatever. But this video, if you've seen this slide deck, this is from the growth portfolio video. I'm going to show you the power and why you would want DGIF in your portfolio. When you see Microsoft and you see the gains that I've gotten on Microsoft over the years from dripping my dividends, you'll want to have some DGIF in your portfolio as well. Stay tuned. Today, I'm going to do a quick video on Microsoft. I'm going to do a couple of things. First, I'm going to give you a quick earnings recap. They just reported earnings last week, and I want to give you an update and tell you what's going on and my thoughts about the share price moving forward for Microsoft. I'm also going to log into my Fidelity account and show you my actual account. I'm going to show you my shares of Microsoft. I'm going to show you when I bought them, how much I paid for them, and what my gains are. The purpose of doing that is to demonstrate the power of compounding dividends, compounding interest, drip investing, DGI, dividend growth investing, where if you buy a stock, if you buy the right stock that has some growth, obviously in the share price, but also in the dividend, if you can find a true, what I call DGIF, that's dividend growth investing for FIRED stock, like a Microsoft, you can see some amazing gains if you reinvest those dividends and you hold for several years. I actually got into Microsoft about 7 years ago, and you're going to be surprised at what I paid for my shares. Before I do that, hold tight though, because I do want to show you my account and show you how much my shares of Microsoft are worth and what I paid for them and the gains. I think you'll find it very interesting. So before I do that, I want to go and do a quick earnings recap of Microsoft. And so it says, despite the coronavirus plaguing the global economy, Microsoft put up some remarkably strong numbers in fiscal Q4. The earnings per share, $1.46 versus expected $1.34. So they had a 9% beat on the earnings per share. Revenues was a 4.2% beat. The year-over-year revenue grew by 13%. Intelligent Cloud, which is probably most important here, is 17% year-over-year rise. And the Azure revenue growth came in at 47% year over year, surpassing $50 billion in revenues for the fiscal year for the first time. And then you've got the productivity and business process unit was up about 6% year over year. Personal computing was up 14% year over year. Looking forward, the company announced it expects $35.61 billion in fiscal Q1 revenues, slightly lower than the $35.91 billion expected by analysts. Still, this would be an 8% year-over-year increase in revenues. That might not be enough at the price it's trading at today. Of course, it closed at over $200 a share. So that is a quick Microsoft overview. The market cap has ballooned to about $1.6 trillion. This is a Seeking Alpha article if you want to take a look at that. It's trading at about 33 times the 2021 consensus EPS estimates. So you've got a mid 30s PE ratio on this thing. So, somewhat expensive. It's a great quality company with a lot of upside in terms of growth drivers. It pays a nice dividend, all those different things. But let's get to the good stuff here. So this is my actual Fidelity account. And you can see that back in 2013, I bought 166 shares in 2 different lots, and the cost basis on that was about $5,000. So my cost share basis per share was $30.29 for the first lot and $30.17 for the second lot. Just about $5,000 cost basis, and I'm up 567% on that. Now I have dividends reinvested, and you can see from 2013, you can see every quarter the dividends that were paid and how much, the unrealized gain or losses for this going all the way down. So here's all 2013 here, all of your 2014, 2015, 2016, and so on. So it shows that, my long-term average cost basis per share is $40.77. Now, because the dividends are reinvested, it's actually going to show more. So if you do the math on this cost basis, back in 2013, I bought about $5,000 at around $30 a share. And then in 2018, we had that big nasty dip at the end of 2018. It was about $100 a share, and I thought that was a good value. So I picked up another 20 shares and about $2,000 worth. So my actual money invested into Microsoft is basically $7,000. It's going to show a total cost basis of $9,000 because about $2,000 is dividends that are being reinvested. So it's going to show that I have a lower percentage gain because it's actually taking those dividends in consideration. But if you look at you just paid $7,000 and you reinvested, this number is actually much higher. And of course, you're also paying your dividend, your taxes and your dividends as you go. So every quarter, every year, I've been paying my, this isn't a taxable account. So I'm paying for my dividend taxes as I go. If I were to sell today, I have 215.283 shares. So just over 215 shares. The reason it's fractional is because the dividends are reinvested and you get partial dividends. If you're familiar with, drip investing, the most recent market value as of today is $43,491. And it's showing an unrealized gain or loss of 34 grand. And so, of course, if I were to sell today, I could get $43,000, but I'd have to pay long-term capital gains on $34,400. Now, if you do the math, my cost on yield is actually pretty good. So based on a $30 cost basis per share, my yield is pretty amazing on that. So you can do the math. I think it's like 6%. So anyway, this is Microsoft. I wanted to show you just a quick video today, the power of drip investing, of DGI type investing where you're reinvesting the dividends. If you haven't subscribed, please do. I do lots of different videos. I like to invest in different buckets. So if you haven't seen my videos on the channel about how to structure portfolios, I've got a couple different videos. One's called How to Build a Growth Portfolio, and that uses a combination of DGI stocks, of growth stocks, of ETFs, et cetera. And I think that would be really, really helpful for you. As a young investor, you want to focus on growth, but you want, you want to have some safety in there too, some dividends. And so the DGIF model is what I use. It's called Dividend Growth Investing for Fired. Those are stocks that will grow in their appreciation of the share price value, but also each year their dividends are going to increase as well. And those are important to have in your portfolio, especially during down times, so that you always have income coming in and that you're reinvesting. You can see how powerful this can be because, we got some great returns, but also the dividends helped in this as well. Please subscribe if you haven't. If you haven't visited our website, it's firedupwealth.com. We also have a Facebook group. Go ahead and search on Facebook group. Just search for Fired Up Wealth. Happy to have you there as well. Thanks for watching. Have a great rest of your day. Take care.